Good afternoon, and welcome this afternoon to Choosing an Option Strategy. My name is Ben Watson. I'm an education coach, and there's the closing bell. And we're going to jump in today. I'm filling in for my good friend Connie Hill today, and we're going to take a look at how we might go about selecting an option strategy. Now, I've got my other good friend, Barb Armstrong, out there in the chat, 20-plus year veteran of the financial markets, and a phenomenal educator as well in her own right. She's going to be there to help answer your questions. But welcome to all of you. Thank you for joining us, whether you're joining in the live session today or whether you're watching this in the recorded version. Either way, do me a favor, leave us some comments, discuss, start some chat there. Barb's going to be there to help facilitate that. And if you're watching in the recorded version, go ahead and leave your comments in the comment section, and we'll get back to those as quickly as we can. And that will allow you to participate in the discussion. So this is an interesting question, the question of how do we select an option strategy. So we're going to talk about that. And I just got done teaching over this last weekend an advanced option strategies workshop in Dallas with Kevin Hinks from the Schwab Network, host of Fast Market on the Schwab Network. Schwab Network brought to us by our media affiliate, Charles Schwab Media Productions, separate but affiliated company. And this is one of the topics that was a frequent part of our discussion along the way. So we're going to follow along. We're going to maybe come up with some not simple, but less complex steps for making a decision about a particular option strategy. So before we do that, a couple of quick housekeeping items. Remember that everything we talk about is simply for illustrative and educational purposes only. It is not a recommendation of any particular strategy or security or pattern or idea or account type. Also remember that options carry a high level of risk. They're not suitable for all investors. Make sure that you're aware of the characteristics and risks of standardized options before considering any option strategy. Remember that multiple leg option strategies will involve multiple commissions. That's a consideration in making a decision. Remember also that spread trading must be done in a margin account. So keeping those things in mind, we're also going to talk a little bit about technical analysis, although there are lots of different ways to look at the market, including probability analysis, including fundamental analysis. All of those are theoretical in nature. None of those are guarantees. Schwab doesn't recommend the use of technical analysis or really any sole means of analysis as sole means or better form of investment research. They're not a guarantee of what the market might do. We're going to be using the Thinkorswim desktop software platform today, specifically the paper money version of the platform, which is a great learning environment. It's a great sandbox to get your feet wet in. However, it is not a guarantee of future success out there in the real world. And as we jump into this discussion again, remember that investing involves risks, including the loss of principal. Those are things to keep in mind. Past performance of any security or strategy doesn't guarantee future results or success. Also, one thing to keep in mind is the potential. It's not a great potential. It's not huge, but that potential for short options to be assigned early if they are American style options. There's the possibility of that happening. It's not a high possibility. That possibility grows as you get close to expiration, close to the in-the-money position. But regardless of where that option is, there is that possibility of that being assigned at any time. Now, as we get into this discussion today, I want to kind of just briefly overall kind of take a look at what one of the slides that we talk about, and we talk about this in Getting Started Trading Options. We talk about this in the Option Strategies Live workshop. We talk about the different strategies that can be applied. And there are a number of those strategies, right? So you notice that by and large, these particular strategies that we talk about, long call, long put, iron condor, cash secured put, short call, straddles, those types of things, those are generally organized in terms of a directional bias. So I wanted to begin our journey here talking about this, right? So this might be the first step. So you might want to write this down. First step in determining which option strategy to choose. And again, there is no one best option strategy. There is no one best option strategy that somebody can tell you about or sell you information about, the best option strategy is the one that you feel comfortable trading and are willing to place and willing to manage the risk. So that's the best option strategy for you as a trader. I'm not giving you advice. I never will. And neither will any other education coach here at Charles Schwab give you advice as to which strategy you have to choose. So notice that the first, like I said, the first categorization of these different strategies is directional bias. So we might write that down. That might be the first thing, is forming a directional opinion. So let's start with that process and go about that process of finding a directional opinion. So I'm going to pop over here to the Thinkorswim desktop software platform. And while I do that, this is a good opportunity for me to remind you to click on that subscribe button down at the bottom of the page. And that subscription is going to help you stay connected to the Trader Talks webcast channel. You can also follow me. You can also follow Barb. She posted it out here in the chat. But you can follow us on X at Ben Watson CS, at Barb Armstrong CS. Great way to stay connected to us. But click on that subscribe button if you haven't done so already. All right, so directional opinion, right? And so what I've done is I've kind of put our considerations on my scratch pad here, and we can kind of refer back to these. So in terms of the scratch pad, the first choice or the first kind of filtering mechanism is determining a directional bias, because that'll put us in the right column for what particular strategy we might use. Now, that being said, don't even be that dogmatic about this, right? Don't think that just because a particular strategy exists in one of those directionally biased columns, you can't think about it from a slightly different perspective. So we'll see what that means as we get into this discussion. But first thing we're going to do is choose a directional bias. And one of the ways that you establish a directional bias is you take a look at what's going on with the market as a whole. The market as a whole may give us some sense of the forces at work in our individual stocks. And so taking a look at the S&P 500 here, I've got my index grid, S&P 500, NASDAQ, Russell 2000. The market's closed, so we know objectively what today has done. We saw that move to the upside of about just a little over 0.5% on the day, and currently sitting at about 55.60 on the SPX, but nevertheless, we've seen a high and a higher low and a new higher high. So from the low point here, back a week or so ago, 2 weeks ago, we're now starting to see this move back higher, starting to see higher highs and higher lows. So we've got a short to potential intermediate term uptrend. 200 period moving average, which is kind of that long-term trend, still kind of going sideways. 50 period moving average, still moving down. So we've got an intermediate to long-term downtrend. We've got a long-term uptrend that is still intact according to the 200 period moving average. So if we take 2 out of 3 ain't bad here, we might say long-term and short-term trends are moving up, and the intermediate term is kind of the decider, kind of the minority report here. So we're going to say, look, this is in an intermediate, well, we'll maybe even call it a short to intermediate term uptrend. So that would suggest perhaps bullishly biased trades for stocks that fall kind of within this pantheon of the SPX. If we were to take a look at the NASDAQ, right, and this is technology stocks, seeing the same kind of thing, right? We've got we've got a high, and we've got a higher low, and we've got a higher high. Now, this happens to be banging its head right into that 50 period simple moving average, which could act as a resistance. We could have a horizontal area of resistance. But from a directional bias, that the NDX, the NASDAQ, kind of making a little bit of a sideways to downward move in the longer term trend. So maybe not quite as much of a bullish bias here, even though today's move was a little bit stronger, 0.61% on today's move, as opposed to 0.53% on the move that we saw in the S&P 500. And now if we shift our gears over to the Russell 2000, the small caps, we've got a high, and we've got a higher low, and we've got a higher high, still well off the 50-period moving average, 200-period moving average generally flat. What I happen to notice here on the Russell 2000 that I didn't really see as strongly perhaps on the NASDAQ, a little bit stronger on the SPX, but the Russell 2000 and the SPX both seeing pretty significant higher highs relative to the previous high on the RSI, that relative strength index. That would suggest, again, a little bit of bullish bias, some bullish momentum growing here, even though we have lower highs if we were to take a look at those two corresponding highs, right? So here's our Russell 2000. We could even go back to our SPX, and we could just say, look, this high to this high right here corresponds with this high to this high right here. We've got a bullish bias beginning or really kind of establishing itself. Again, that's more of a bullish bias, bullish divergence suggesting some upward movement in the price of this index. Same thing's happening on the SPX. Not quite to the same degree on the NASDAQ, but that would suggest some bullishness, right? So the first part of our opinion, bullish. Now we're going to do the same thing for individual stocks. We're going to kind of go through the same perspective and see what we're looking at, right? So FinWest asks the question, how would these indexes? Well, these are the equity indexes, right? So if you were looking for something that was trading in oppositional movement or inversely correlated or non-correlated to something like crude oil or bonds or gold, you would look at this index in comparison to those instruments as well. Michael Fairborn does teaches a great webcast on Wednesday afternoons on market and sector analysis to take a look at some of those relationships in between markets and in between different instruments. So great idea to talk about that. But now we're going to focus again on some individual positions. All right. So now that we've kind of established our overall bullish bias, so we're bullish to maybe neutral, neutral maybe to bullish, depending on which way you phrase it. Taking advantage of that movement might be a function of how bullish we think we might be. So right up against a resistance level here on the Russell 2000, right up against perhaps a resistance level on the SPX, but we've got a little bit of room to go before we get to that moving average, and probably a little bit stronger bullish divergence here on the RSI. So maybe a little bit more strongly bullish on the SPX. So again, the next thing that we might do in terms of choosing an option strategy, right? Once we've established our directional bias, is now to look at the potential time frame. And part of looking at the potential time frame incorporates, and let me just kind of bring up that little scratch pad, right? So we're going to just say this: our bias is bullish based on what the overall market is doing. But time and news and news and volatility, news and time are kind of interrelated with one another. So as we start to look at individual positions, the time in which we might look at placing a trade and the corresponding strategy to that might be something that is governed by news events. Now, here's something that we can think about. One of the things that we have to pay attention to is the fact that just over the horizon, and I'm going to grab my my time hack here so we can do this on 5/7. We'll go right here to 5/7. That's next Wednesday, right? And that is the FOMC meeting. So that might be something to pay attention to in terms of the duration of trades that we might be looking at. That particular meeting, while maybe not returning any changes to policy, is certainly going to change some language, and that's going to perhaps change the movement of the market. So we know that there's that news event that's coming up, right? That is the FOMC meeting. That's something to pay attention to. This Friday, we have non-farm payrolls. So that's going to be a news event that we're going to have to pay attention to. So in terms of determining our time frame, that might be better suited rather than looking at the overall market. Now that we know that those things are in place, we're going to look at individual positions or individual possibilities simply from the standpoint of how their news flow individually might influence the time in the trade. And then the third thing that we're going to pay attention to in this mix is probably the big one, and that's volatility. So in time frame, I'm going to do this. So we've got May 7th. Actually, we've got May 2, which is jobs. We've got May 7th, which is the FOMC meeting. And then we're in the middle of earnings, right? So we're thinking about earnings as well. That's going to be an important issue to pay attention to, because that's also going to influence volatility. So directional bias, time and news flow that we need to be aware of, and then volatility. So let's take a look at volatility overall really quickly here. What I'm going to do is I'm going to change my grid really quickly to our VIX grid. And we'll take a look at what the VIX is doing, the volatility index of the market as a whole, the S&P 500. We see that the VIX has been significantly higher, is up in that 60 handle. Now it is back down in the middle 20 handle. It's right about 24 in this particular case, and kind of sitting right there. It has come down. It is likely to fall further until maybe we see some impact to this because of a news story or a change or a tweet or something else, maybe coming out of the administration, maybe coming elsewhere, that causes the market perhaps to feel some fear again. But that fear that the market felt a couple of weeks ago has bled off very, very quickly. Sometimes maybe not as quickly as we see other fear events bleeding off. This was a little bit more persistent. Volatility generally lower, right? In fact, one of the things to maybe determine where volatility is I put a 30-period moving average on volatility. This is the 30-period moving average of the VIX. And I can see that that 30-period moving average is about the 28 mark. VIX right now is at about 24 and a quarter, 24.17 to be exact. That would suggest that volatility right now is below the average, below the 30-period average. Even though that 30-period average is very elevated, it's still right now, VIX is below that average. So VIX, we could maybe say objectively, VIX is relatively low. So let's grab our time frame here, or our scratch pad, and we'll say VIX lower than it has been. Right? Not VIX is necessarily low, because low is down here maybe in the 15 to 13 range, but VIX is lower than it has been. And when VIX is low or lower, that presents the opportunity or potential for it to rise. Right? Now, it could still go lower, but a low VIX, low volatility, that's going to be an option strategy selection criteria. So now that we've kind of got a sense of what's going on, we know what news flow is doing. That's kind of along the way with this time frame. Emergent news, we never know, right? We never know what's going to happen to news ahead of news. Because news is just that, right? It is news. It's something that has happened unusually. And to try to get out ahead of that is, I think, a little bit self-defeating. So one of the things that we might do in terms of choosing a stock, perhaps to put or to determine a strategy on, might very well be looking at trading liquidity. So when we're trading options, there are two functions, kind of two focuses of liquidity. One would be the liquidity of the underlying stock. And the other focus of liquidity would be the options on that underlying stock. So we're going to start with the liquidity of the underlying stock. So what I'm going to do is I'm going to go to the scan tab, and I'm just going to do this really quickly. And you can do this as well. I'm just going to reset this scan. And I'm going to just look in S&P 500 stocks. Okay. So I'm going to come down here to publicly available watch lists, and I'm going to just search in S&P 500 stocks. And I'm going to do something here with this intersection. I'm going to say, I want to find stocks that have, we could do all optionable, but I'm going to go a little bit better than that. I'm going to come down here and say, I want stocks that have weekly options listed. Now, one of the reasons why we might choose stocks that have weekly options listed is those weekly options come as a function of demand. When there's more demand for those options, option exchanges are going to list weekly options. If they don't have weekly options, generally it's an indication, not always, but it can be an indication of stronger demand for options for that underlying stock. So the next thing that we're going to do now, if we were to just look at volume right here, right, and we've got kind of three choices in this mix that are predefined or pre-built. Net change, volume, percentage change. That's fine. But what I want to do in this particular case is I want to kind of suss out the liquidity of these individual names. So what I could potentially do in this case is I'm going to take out those two other filters and we're just going to look at volume. Now, this volume right here is misleading. This is not average volume. This was today's trading volume. So what we might do is just say today, because it was a typical Monday, generally, look for volume of better than 1 million shares traded. So that's going to tell me that I've got a relatively liquid stock, generally. Doesn't guarantee it, doesn't guarantee tight bid-ask spreads, and doesn't guarantee that the options are going to be liquid. But that's going to get me in the right neighborhood. Now, what I'm also going to do, now, remember I said there are differences between paper money and live trading? This is going to be one of those differences, so pay attention to this. I'm going to add a filter, and I'm going to add a study filter. Now, in the Thinkorswim paper money platform, study filters in scans are not enabled. Let me just say that again. In the paper money platform, Thinkorswim desktop, study filters are not enabled for paper money. So this has to be done in live, but I'm not going to tell you to do anything in a live account. I'm just pointing out the difference. So what I'm going to do now is I'm going to come down to, when I've got study, I'm going to come down to volume, and I'm going to look for now average volume. And I'm going to look for average volume over a period of time. So this by default comes to the 50-period simple moving average of volume. I want to even shorten that up just a little bit. I want to make this the 30-period moving average of volume. It doesn't have to be an exponential moving average. It's not that precise. I just want to get us into the right neighborhood. And I want to say that on average, this stock has better than 1 million shares average daily volume based on that 30-period average volume average, right? So I'm filtering this not only on absolute volume on this particular trading day, but on the average of volume over a number of days. That's it. That's all I'm going to do. And I'm going to click on scan. And now I've got 224 results that we get based on that, right? Out of roughly 500. Right? So we've narrowed it by about half. Now, you individually, you collectively could continue to filter even more if you want to. I'm not going to do that because this isn't a scanning class. This is a choosing an option strategy class. So I'm going to look for stocks that I recognize in this list. Now, these are all S&P 500 stocks, so I recognize a lot of them. But this is where we also need to start paying attention to this one, news and time, because we're in the middle of earnings season. So that's where these icons can come in handy. If I wanted to find a stock that was past its earnings announcement, or its earnings announcement wasn't scheduled within a reasonable time frame, I'm going to look for stocks that do not have that blue icon. Now, I can sort this list alphabetically, and I'm going to probably get some groupings of those symbols. It's not going to be guaranteed. Now, I could also put a column here that would show earnings coming up, but I can do that really quickly with that icon. So if I wanted to look for a stock where there was not an earnings announcement, let's say, for instance, Boeing, which has already released their earnings, then I could choose to look for one that doesn't have that blue icon telling me that there's an earnings announcement. If I wanted to choose a stock where there was an earnings announcement within the time frame, right? Within that time frame that I'm looking at, then I could look for one that has that symbol, that little blue symbol right there. So let's choose two out of this list. We're going to choose ConocoPhillips, and we're going to choose Boeing. So BA is this one. Boeing has already had their earnings announcement. ConocoPhillips has an earnings announcement coming up, probably in a little bit. If we were to hover over that, we're going to see when that earnings is. That's going to be end of next week, right? So that gives us a little bit of a time frame. Boeing's already seen their earnings. So let's start with the one that doesn't have the earnings announcement coming up, and that's Boeing. And what I'm going to do is I'm going to go to my chart. I'm going to bring up my single grid here on my chart. My single grid is just kind of the sandbox that I use to look at individual stock symbols. And we're going to take a look at Boeing, BEA. So now we could do the same thing. We could put our moving averages on here. We could put RSI, whatever we wanted to do. But again, the selections here are exactly the same. If we come back here to our scratch pad and we say, all right, now for Boeing, let's just do the same thing, BA. Directionally bullish. It's been moving higher. We've seen this pretty strong move to the upside, maybe running into a little bit of a resistance level. So I'm going to call this neutral to bullish. Okay, so that's my directional bias. Time frame, we're already past the earnings announcement, so my time frame is really kind of this broader time frame of the market as a whole. So I'm just going to do this. I'm going to copy that, and I'm going to put that down here. And I'm going to take out earnings because it's already past its earnings. So I still need to be aware of jobs report and the FOMC meeting as some of those time-based considerations to keep in mind here. The next thing that we might look at then is volatility. Where is implied volatility for this particular stock? So let's do this. Let's go to our chart and let's put on here IMP. So we're going to put on implied volatility down here at the bottom. Now this is one way to look at that implied volatility. So what do you notice here? Implied volatility expanded greatly as the price of the stock was coming down, and it rose back up again a little bit into the earnings announcement. Since that earnings announcement, implied volatility is, I can look at this chart and see that implied volatility right now at the 39% is relatively low. There are two other places that I can go to look at volatility, right? What I'm going to do is I'm going to go to the trade tab for Boeing. And so I'm going to say, look, where's volatility and what's it doing? Vol, I'll just type this in here, vol. And volatility is likely to be relatively low. One way that I can do that, and again, this is maybe a key for an option strategy selection process, is this right here. Today's option statistics at the bottom of the option chain, and then this number right here, current implied volatility percentile. So I know that implied volatility right now is 39%, but I don't know if that's high or low. What I do know now is that the lowest it's been in the last year is 29%. The highest it's been in the last year is 80%. So that puts this down at about the 19th percentile, which would suggest that implied volatility is low and likely to rise. So if implied volatility is low and likely to rise, then that's going to be part of our option selection criteria. So we're going to say low and likely to rise. Simply because when volatility is low, it tends to go up. And when volatility is high, it tends to come down. Now, is there any news announcement? Well, that goes back to earnings. If I knew anything else in the news flow, I might want to pay attention to that too. I could check live news, but I don't know necessarily that there's anything in terms of that live news flow that really would be getting in the way of perhaps making a trade. So knowing that these two events, the May 2nd, May 7th events, are likely to create higher implied volatility in the market as a whole, that's going to be beneficial to kind of sell volatility around that time frame and buy when implied volatility is low. So we might go to a strategy. So let's go back to our charts for just, or our slides for just a second here. So we've got a bullish strategy that is maybe neutral. So we've got a couple of different choices here. So maybe if we were to look at a bullish strategy, taking advantage of low implied volatility with the potential to rise, that might be a strategy that would be benefit by a call diagonal spread or a long call vertical, buying an option, or buying a vertical spread, or buying a diagonal spread. Another that we could choose, if we were more neutral on the movement of this stock, we might choose a double diagonal, which would be 2 diagonal spreads. So buying and seeing that implied volatility rising is going to benefit us there. An iron condor really wouldn't for neutral movement, simply because implied volatility is low and potentially rising. Same thing with the calendar spread. Low and rising implied volatility probably not going to benefit that calendar spread. So I'm going to choose one of these 2 here. Now, knowing that I've got a short time to go until that FOMC meeting that's likely to create higher implied volatility, and we're likely to see that go down afterwards, I'm, out of these 2, going to choose the one that gives me the ability to separate both my long leg and my short leg expiration dates, so that I can take advantage of potentially inflated implied volatility in that front expiration. So I'm going to choose, in this particular case, a long call diagonal spread. That's the easiest way to get there from basically what we've been talking about, right? So again, let me just bring this up, and so we can kind of go through this once again. Let me bring up that consideration here. So Boeing, neutral to bullish, so bullish bias. Time, we know that we've got a couple of news events market-wide that are going to have an impact, and we know that implied volatility is low and likely to rise. We don't know any other earnings announcement or any other news events that might drive this stock to move. So that means out of that selection, our selection is, in this case, long call diagonal. And long call diagonal allows us to take advantage of that bullish bias. Directional bias, out of these choices, directional bias is almost always going to be the biggest influence. And it begins with your opinion of what that directional bias might be. So let's go ahead and let's choose that, and let's put that strategy on here really quickly. So we're going to pop back over here to the Thinkorswim platform, and we're going to say, fine, I know that I'm going to have a news event that's coming up in this next time frame, right? This next week or so. We've got the non-farm payroll. And you happen to notice that implied volatility is relatively elevated relative to other implied or other expiration dates. So here's the thing. That 44% implied volatility is higher than the next expiration's implied volatility. I want to be able to take advantage of that. So that's part of the choice. So the next thing I'm going to look at in terms of that implied volatility is this move right here, this implied move of the price of the stock, either up or down based on that level of implied volatility. And that's going to give me the ability to select where I'm going to choose to sell this option. So for instance, right now, what I'm going to do is I'm going to go out enough time that I'm mitigating a little bit of the time decay and still taking advantage of that rise in implied volatility. I'm going to go out to the 30 May expiration. And the price of the stock is currently trading at about 182. I don't need 150 strikes to get to this. I'm going to put on about 30 strikes. So that's going to be about 15 up and 15 down. And I'm going to go to the one that is kind of right at the money position. Now, recognizing that the market is now closed, these spreads have become a little bit wider. So I'm going to go to the 180 strike. It's a little bit in the money. It's still the at the money strike, the 180 strike. And we're going to look at buying the 180 strike out at the 30 May expiration. Okay, that's going to be the first leg of our diagonal spread. Now, I'm going to come back in and I'm going to say, where do I think this stock is going to go? Likely move to based on that level of implied volatility that we saw in that front month. I'm going to take advantage of that higher or inflated implied volatility, so up about 5 points. So if we think about where that would be, that's going to be about 187. So I'm going to come here to the 2 May expiration, 3 days to go until expiration. And I don't have a 180, I don't have a 187 even. I have a 187 half, and I have a 185. Now I bought remember, or we created that order to buy the 180. So I could do the 185 or I could do the 187. And the question is, what do we want to have happen here? Well, I want this to be in the money at expiration. So in this particular case, I know that that 187 might not be as liquid as the 185. So I'm going to sell the 185 for this diagonal spread. And I'm going to do this. And here's the thing, because I'm selling this I've got a $5 wide vertical spread, and I'm selling it for, I'm buying it for more than the value of that $5 wide vertical spread. That might be a concern. It just simply means that the stock has to move quickly. What if it doesn't? Well, then let's see if we can widen this out a little bit. If it doesn't, one of the things that we could do is we could adjust this trade. So we might try that 187.50. Now we've got a 7.5 wide and we're buying it for $8.10, right? So what we might think about doing here then is maybe coming back in an expiration date, making that long leg a little bit cheaper. Let's go to the 23 May and see what that looks like. So now we're buying a 187.50, 180 long call diagonal for just about the cost of the spread. I'm okay with that. I'm okay with that, paying just about the cost of the spread here. So what we're going to do is I'm going to simply right click. We'll send this to the Analyze tab, and we'll take a look at what this looks like. So I'm just going to squish this in here, unfloat that vertical scale. And here's what that characteristic risk profile graph looks like for a diagonal spread. So remember, I was kind of neutral to bullish on this. So here's what this is going to look like. The max theoretical gain in this trade occurs if at expiration, the price of the stock is right there at that discrete point, at that 157.5, right? But what if it goes up beyond that? Because that's kind of inside that expected move in the price of the stock. So I've given myself a little bit of room to still make some money in the trade, even if this goes up a lot. If that short leg is assigned early, great, we're at maximum theoretical gain, and at least maybe we break even on the trade. So this is kind of how we go about selecting this strategy. And I know that my maximum theoretical loss in this trade is capped at that $7.52. So that's how I got to that selection. Now, here's the other thing to think about is I'm not necessarily done with this trade. It's not a set it and forget it, because if I go back to the trade tab, I know that if I close this down, there's the possibility if, for instance, the price of the stock doesn't get there, or I close down this 2 May expiration short leg, I've got one and then maybe two, probably just one roll out of this particular strategy, so I could adjust the strategy and keep it going while chipping away at the cost of that long leg. So directionally biased, but taking into account low implied volatility, but elevated implied volatility in the front month. Now, let's do one more real quick. Because remember, our other example was ConocoPhillips, right? COP. So let's see what ConocoPhillips is doing. So here's another scenario. Directionally, what's our bias? Well, we look at this from the standpoint of being a high volume or high liquidity stock, right? We've got an earnings announcement that we've got to pay attention to. That's inflating implied volatility or keeping implied volatility relatively high. And we can also see that maybe that movement is somewhat neutral in between this support level and maybe this resistance level right here. Implied volatility staying a little bit higher. So we could choose a more neutral to bearish strategy. You know, we could do a long put diagonal here. But that long put diagonal, if the price of the stock goes up, that's going to inflate that long leg. But if we hold that long leg through that earnings announcement, that's going to likely deflate that implied volatility, probably going to defeat the purpose. But if we choose neutral strategies that might benefit from falling implied volatility, that might be something like an iron condor or a short vertical spread. So for simplicity's sake, I'm just going to look at, say, for instance, in this particular case, a short call vertical. Okay, so kind of falling in this bearish to neutral range. So short call vertical, we're going to sell that above where the price of the stock is at this point. So I'm going to come back over here to the chart. I'm going to say, look, there's our resistance level that this has run into. Implied volatility is relatively high. We're going to double check that, and we're going to say, look, let's go to the trade tab for ConocoPhillips. Let's come down here and let's take a look at today's option statistics. And it's in about the 39th or 40th percentile, still relatively neutral, not overly elevated, so we can still pay attention to that and take a look at that. So what I'm going to do now is I'm going to look for an area that has elevated implied volatility. I'm going to look for a strike price. So this 9 May expiration at about a $6 move. So I want this option, this spread to be out of the money. So I'm going to go outside that $6 move to create this vertical spread. We're going to do a short call vertical spread. So I'm going to open up this option chain. Stock's currently trading at 92. So we want to be at 98 or higher to sell our short leg. So we're going to come down in our option chain. We're going to go out here to about 98 to that 98 strike. So this is where we've got to strike a balance in putting this trade together, because look at this, selling that 98, we're not bringing in a lot of premium here. So what we could do is we could even maybe bring that back in, recognizing that the market, especially in elevated implied volatility, tends to overprice that expected move. I'm going to come in one strike, and we're going to go to the 97 strike. And I'm going to say, fine, let's sell the 97 strike. And at the same time, we're going to buy the 90, let's buy the 100 strike. Okay. So now we've got a $3 wide vertical spread that we're bringing in about 41 cents for on a $3 wide vertical spread. A little bit low, but that's okay. We're going to expect that implied volatility is going to fall post that earnings announcement, and we're going to sell that premium and bring in that premium. So let's put this up on the Analyze tab, take a look at what this looks like, and I'm going to take my other position off. Here is our short put vertical. Let's set our slices to break even here. And so we've got to see the price of the stock stay, in this particular case, at or below 97. Well, we're kind of there, right? We're selling this call spread at about that 97 strike minus the premium that we're bringing in, or plus the premium that we're bringing in. That is our break even point. So we want to see the price of the stock go down. If it goes up, we know what our maximum theoretical loss is on this trade. We click on confirm and send. We can see that our max theoretical loss in this case is $2.59. So if we kind of plan for that in terms of our maximum theoretical loss and our position size, yeah, we did a short call vertical spread. That is exactly what we did in this particular case, was a short call vertical instead of an iron condor. We could do the other side of the iron condor here as well, but I wanted to do the short call vertical because we know that an iron condor is simply a short call vertical and a short put vertical. So I wanted to do at least half of it and go through that strategy selection. So let's just revisit this really fast before we go. I know we're running out of time, but again, these are the considerations: direction, time, volatility, and news. And that's your kind of shorthand for selecting an option strategy. If you want to learn a little bit more about this or other strategies, this is a great place to do that. Come over here to the Trader Talks webcast page and search for the topic at hand, and you can join us for those events. We would love to have you join us for those events. We would also love to have you join us for our in-person events. If you're going to be in the Denver area, come and join us this coming weekend. Friday and Saturday, we're going to be teaching technical analysis and option strategies. Then on the 30th and 31st of May, we're going to be in Anaheim, California, teaching another advanced options strategies workshop. We would love to see you there. And then coming up in June in Miami, we're going to be at the Market Drive one-day event. It's a great event, good opportunity to learn a lot about all of the offerings that Charles Schwab brings to the table. Guys, thanks for joining me today. Thanks to Barb Armstrong for helping out. Remember to follow us on X. Thanks to Bree and all of our great production staff for helping to bring you this great webcast today. We will see you again very soon. Have a great day. See you back here again tomorrow for a full slate of content. Take care, everybody. Bye-bye.